Hello everyone, my name is Divam Sharma. I am from Green Portfolio. Today I am going to talk about dividends. So what is the typical dividend payout ratio for a company in India? So dividend yield of Nifty 50 companies is somewhere around 1.46%. While some companies abstain from giving dividends, some prefer reinvesting the capital for future growth of capital. While some companies have a high dividend payout ratio as a percentage of earnings per share, if you look at some of the PSU stocks like NMDC, REC, Hoodco, and Coal India, if you talk about dividends further, dividends can be in the form of cash, stock, or assets. Usually, we see dividend in the form of cash. Dividends can be regular, which could be final or interim dividend, or they could be special dividend. Dividend can also be asset class specific, like dividends from general stocks, dividend from preferred stock. How do companies decide how much dividend to distribute? So dividend distribution is not mandatory. Dividend payouts usually attract investors. Depending on the stage of company, if it is a mature company and has a stable income, dividend payout policy is created which establishes dividend as a percentage of profits attributable to equity shareholders. So every year, like say a dividend payout policy lays out that 20% of the earnings per share will be distributed as dividend. So say next year my earnings per share is 10 rupees, my dividend would be somewhere around 2 rupees. Any extraordinary income or cash flows like slump sale of a business unit, the company may declare a special one-time dividend. How do dividends impact a company's stock price? So if the dividend is consistent, this shows strength in the company. Companies get access to investors chasing dividend yielding stocks. Long-standing history of dividends, it gives shareholders an additional appetite to invest in the company. If there is a long-standing dividend history and the company reduces the dividend payout policy as a percentage of EPS, this could be negative for the company. New dividend payout policy, there could be appreciation in the stock price. The stock usually adjusts to the dividend post the record date. If the dividend is substantial versus the stock price, the adjustment is visible on the next day of opening of the stock. We have learned that companies paying dividends tend to be more resilient during market crashes or correction. During the times of interest rate rises, the earnings yield and the dividend yield give these companies some cushion. So this is the case with the current correction in the markets. So usually there are a lot of investors who chase dividend yield stocks and they invest in companies having high dividend yields. So what are the tax implications of receiving dividends in India? Dividends are chargeable to tax in the hands of investor at a normal tax rate as applicable if shareholders are holding these shares as an investment. So this is treated as other income. Shares are held for trading purposes, then dividend income shall be taxable under the head business profession. Usually, a TDS of 10% will be deducted from dividend distributed to the resident shareholders if the aggregate amount of dividend distributed or paid during the financial year to a shareholder exceeds rupees 5,000. In case of an NRI, a flat 20% rate is charged. They can take benefits of double taxation avoidance treaty with their respective nations. Are there any regulatory guidelines in India that companies must follow when distributing dividends? So there are many basic checks as per Companies Act, like the board of directors determine the rate of dividend and recommends to its shareholders. The shareholders then declare the dividends in the annual general meeting through passing the resolutions. Dividends shall be paid out of the profits only after providing for depreciation and after adjusting the carried forward losses. Banking companies have some additional regulations regarding declaration of dividends. Before declaring of dividends, certain percentage up to 10% of the profits should be transferred to reserves. Now this is a general rule. Dividends declared should be paid in 42 days. If there are dividends declared and unpaid after 42 days, post 7 days of that, the amount should be transferred to a separate bank account of the company with a scheduled bank. Any unpaid dividend or unclaimed dividend for 3 years shall be transferred to General Reserve account of central government. How do companies in India compare to companies in other countries in terms of dividend payout? So in terms of dividend payout in India, as compared to the world, we have seen a high dividend payout. In 2020, Indian companies paid 30% of the income as dividend, whereas the global average was 22%. Indian investors place a high value on dividend income, encouraging companies to maintain a higher dividend payout ratio. How do one evaluate a company while placing promoter holding with a high dividend payout? So if you want to evaluate such kind of a company, you have to look at first promoter holdings. So a high promoter holding is a positive sign. This gives the promoter incentive to work and also ensure a long-term growth in the company. In terms of dividend payout, you have to ensure that dividend is not a one-time in nature. In case of a special dividend of a situation, say a slump sale of a business unit, this could be one time in nature. But if you are a dividend yield investor, you have to look at a consistency of the dividend. You have to ensure that you have a regular dividend income and a regular income stream from these dividends. Investor should also ensure that the company has a sustainable dividend policy as a percentage of EPS and is not sacrificing the long-term growth prospect for the short-term gains in terms of distributing as dividends. If you look at some old-aged promoters who do not have a second line in business, or some MNC promoters, they usually have a high dividend yield. You have to look at financial performance. So despite the dividends, if I have a dividend payout policy and my income is not consistent and my income is not visible in the future, I will not be able to pay dividends. So as an investor, you should analyze the company's financial prospects, the financial performance, including the revenue growth, profit margins, return on equity, debt levels, industry prospects, future steps taken by the company to grow its EPS. So what should investors look at when analyzing a company's dividend history? Investors should look at consistency, whether the company has paid dividends consistently over a long period of time. Investors should look at growth. Has the company increased its dividend payments over time? A history of increase in dividends is usually a positive sign. Now, if you have a consistent dividend payout policy and your EPS is increasing, that means your dividend is also going to increase. A payout ratio. So what percentage of company's earnings is being paid out as dividends? A very high payout ratio could indicate that the company is not reinvesting enough in the future of the company. And that could sometimes be negative as well. So you have to have a balance of reinvesting the profits back into the company as well as paying out as dividends. Can dividend payouts be used as a reliable indicator of the company's financial health? Usually, they are financially stable indicators, but whether they are doing exceptionally well or not cannot be determined. A one-off special dividend based on receivables of a business sale does not indicate a super healthy sign for the company. Also, in some cases where dividend is to be sent to parents, holding company for managing its obligation need not be a healthy sign of the company. So usually a high dividend yield is healthy sign for the company, but it is not so always. There could be a lot of exceptions to it, like a one-off special dividend which is being paid as a result of slump sale of a business unit of the company need not be a healthy sign. Also, in cases of dividend is sent to parent holding company for managing its obligations need not be a healthy sign.